The likelihood of us going into recession is even greater and greater now.
The average person who has a mortgage on their house has $64,000 of equity.
Right now in the range of about 6.5 to 6.75% interest rates.
Holy smokes.
Yeah.
Okay.
Then they're going to start laying off people, and I don't see how that's going to be good for our industry.
Redfin just cut 8% of their employees because home buying demand went down a lot more than what they were expecting. Interest rates have now risen again. We also are hearing everywhere that we are going into a bear market. The 2-year yield treasury is higher now than the 30-year. And so today we're going to talk to Mike. Mike's going to explain how does the treasury and the bonds, how does that affect the interest rate and the housing market? What are basis points, and what does that mean when everybody's talking about the Fed's raising 100 basis points, 50 basis points, 75 basis points? And so let's get into it. I just want to say thank you to all our new subscribers, and if you haven't subscribed, subscribe now. Hey, Mike, thanks for joining us today.
Thank you.
Yeah, how have things been? I think it's been maybe a month since you've been on, so.
I think so, yeah. Definitely rates have been changing rapidly.
Yeah.
And unfortunately going the wrong direction almost every day. So,
yeah.
It's definitely impacting our business and our local market here for sure too.
Okay, so with the Fed's talking about raising interest rates, we also talked the market kind of shot up here at the beginning of the week. What are interest rates floating around? I know it's hard to say, but.
Well, on a 30-year fixed rate right now, assuming good credit scores and at least a 20% down payment, we're right now in the range of about 6.5 to 6.75% interest rates.
Holy smokes.
Yeah.
Okay.
Idaho housing is lower than that.
Okay.
They're still holding in as definitely a very strong option for people to consider.
Okay.
And a lot of people kind of assume that Idaho housing is only for first-time home buyers, and it's not. So I think people need to kind of realize that they just need to get out and talk to you and me so that we can tailor a loan program that's going to meet their needs. So
yeah. Sorry guys, this is only for Idaho residents. So if you don't live in Idaho, you don't get Idaho housing. But for the Idaho housing people who are Idaho residents.
And in a meeting I had a little bit earlier today, mentioning how sometimes the market, in anticipation of what the Feds are going to do by raising the rates again, that sometimes the bond market will bake that in anticipation of that increase. So we see that happening this week.
I was going to ask because a couple charts that I was watching, it looks like sometimes the interest rates shoot up and then they slowly climb down, and then they shoot up again and slowly climb down. And is that why? Because so the investors or the mortgage brokers, they anticipate the rate hikes, or why is that?
Well, we have a saying in the lending industry that rates usually will shoot up like a rocket and float down like a feather.
Okay.
So when things start to get a little bit more volatile, they'll shoot up really fast because they don't know how bad it's going to be, how fast they're going to shoot up. But then when things start getting better, they don't want to lower them as fast as they went up because they are worried about that bounce in those curves. So
so that makes sense. So my question to you is mortgage applications. There was a news article that I just read that said that they are at a 22-year low. Is that true?
I think nationally, we're way off. Refinances have almost completely gone away, and the purchase business loan applications are way off also as a result of rapid appreciation, rapid rates, and rapid inflation. So it's not keeping up with the increased wages that some people are getting, and not nearly enough people are getting that. So.
Yeah. And so with that being said, I mean, again, the news is always saying worse than 2008. We're headed to a recession. Do you think we're headed to a recession? What are your thoughts?
Well, whenever we see the bond yield curves do what they're doing, I'm hearing more and more day by day that the likelihood of us going into recession is even greater and greater now.
Okay.
We thought as an industry that maybe inflation had peaked, and it didn't. So it just continued to go up even more right when they thought that maybe it was going to peak and start coming back down. And I think that's just compounded the whole effect of interest rates, that and the fact that the Fed's backed off on mortgage-backed securities. It's really a market that's being driven by the bonds.
Okay.
And the yield curves. So what has been going on for quite a few years now to try and help keep the rates down, the feds were kind of influencing the market by putting money into the mortgage-backed securities. Okay. So the Fed stopped putting money into the mortgage-backed securities, and now the market is at its true reaction to the yield curve based on the bond market now.
Okay. So was that like false stimulation from the feds, or?
Technically it was.
Okay. Okay, so the feds poured some money in, and now they're like, okay, we're done. And so have they pulled it back, or are they selling those?
I think they've just about eliminated it completely.
Oh,
and
wow.
that's why we're seeing the volatility that we are because of the compounding effects of everything else going on in the world. So.
Okay. Now, with them pulling back, that's not because people are defaulting on their loans, correct?
No.
Yeah, it's what we also saw an article that the average person who has a mortgage on their house has $64,000 of equity, and here in the Valley, I think that's way under. I mean, I think most people are about double that. So, so that's good news. We're not in a foreclosure market or a short sale market. We're just in people are sitting dandy where they're at. Is that kind of
sitting on the fence,
Yeah.
as we say.
So 75 basis points. Can you explain what is that?
So 100 basis points equals 1% or
Okay.
1 point. So when they say they're going to increase it by 50 basis points, that's 0.5%.
Okay. Okay. Yeah, that makes a lot more sense. They're always throwing around these basis points, and I'm like, what is this basis point?
BPS is what you'll see the initials to be for basis points.
Okay. It all
BPS, basis point spread. So.
Okay. That makes sense. Okay. Perfect. Now, with the Treasury, can we go to the whiteboard, and can you kind of help us understand how does the Treasury and the yield curve and the bond market, how does that all affect what's going on with the interest rates and how people react?
Yes, be happy to.
Perfect. Let's go to whiteboard.
All right, so mortgages are tied to bonds, and how the bonds move is what will impact how the mortgage interest rates work. And in a healthy yield curve for bonds, and this is what would be considered typically a more normal market, okay? And here you've got the short-term bonds and your long-term bonds over here, okay? So what happens is the longer-term bond, that's a higher risk bond, but it's going to pay a higher yield. And so as it pays a higher yield, then when the bond market yield is up, then that usually drives the interest rates down, okay? When the yields go down on the bonds, then that drives the interest rates up, okay? And so what we're in now is, again, year one here, we're in what's coming into an inverted yield curve. So here we have the bonds worth X right now, but the long-term bonds, these 30-year bonds, they're worth less than what the short-term bonds are. And because of that, it's driving the interest rates up substantially. The interest rates are going up mainly because of the bonds, but what we don't understand, I think, as a society is how is it that it's good that the feds are raising the rate to try and slow inflation? And because if more and more people can't afford to even go anywhere, recreate, go on vacation, spend money, then to me that's kind of a reverse effect of the feds raising the rate. So I'm just not sure how to understand what is going to be the results of the feds raising the rate, because it's going to make it all, everything more expensive for all the rest of us. So the risk to me, in my opinion, is if these companies aren't making the money they used to make because the feds raised the rate, then they're going to start laying off people, and I don't see how that's going to be good for our industry.
Thanks again for coming on here and helping us kind of understand. So right now we're in the negative yield, and that's why their hope is to raise interest rates, which a lot of Americans are scratching their heads saying, how is this really going to help? Because it might actually hurt us more than help us with causing more layoffs and that kind of stuff, because profits are going down and they got to keep corporate America happy. But I want to end with the good news. Remember, an article came out, there's $3.8 trillion of equity in homes spread throughout the United States, which means that amazing things is if you own a house, you're sitting on equity, and more than likely you locked in a great interest rate when you bought that, and so you don't have to sell. But if you wanted to sell, you could cash out on your equity, right? You could do that, or you're sitting on a very good interest rate, and although people are having to buy with a higher interest rate, and so now their mortgage payment may be $200, $300, $500 more, yours isn't, and so that's good news. And so although there's a lot of bad news out there, there is still some good news that we can hold on to. And so with that being said, I just want to thank you again for watching. Let us know your thoughts. What do you think? What do you think about inflation? Is rising the rates, is that really helping? Are you seeing something that we're not seeing? We want to know your thoughts. And again, if you haven't subscribed, make sure you hit that subscribe button. And to all of our new subscribers from our last video, thanks for joining us.